Hello everyone, and welcome back to Collin Investing. Today we're diving deep into the US stock market, the escalating tariff situation, and what it all means for the economic outlook. We got a lot of ground to cover, from the latest CPI data to the ongoing trade tensions, the Fed's next moves, and even some key company updates. We'll break down the complexities and, most importantly, offer insights that are actionable. So let's dive right into the market's reaction to the latest economic data. We saw the February CPI data come in, and it showed slower inflation growth than anticipated, clocking in at 2.8% year-over-year. That was better than what most analysts were expecting. Naturally, this fueled optimism. And what does lower inflation usually mean? You guessed it. Traders immediately increased their bets on Federal Reserve rate cuts, with the consensus now pointing towards at least 2 cuts within the year. Initially, the market responded positively, popping on the news. However, and here is where it will turn. This is where the volatility kicked in, largely driven by those lingering tariff concerns. Although the Nasdaq led the gains, climbing a solid 1%, and the S&P 500 also finished in positive territory, on the other hand, the Dow Jones Industrial Average actually closed down 0.20%. It's also could tell from the section's performance. The leaders were technology, communication services, and consumer discretionary, whereas we saw staples and healthcare lagging behind. This divergence really brings the uneven impact of the current economic climate across different sectors. But that's not the whole story, because while inflation might be cooling, the trade war drums are beating louder. We've officially entered a new and frankly concerning phase of escalating trade tensions. The US tariffs on steel and aluminum, which we've been talking about, have now taken effect, and importantly, there are now exemptions. This isn't targeted. It's a blanket approach, and the response, swift and substantial. Canada immediately announced retaliatory tariffs totaling a staggering $29.8 billion, effective the 13th of March, that's today. The European Union isn't far behind, planning tariffs on $26 billion worth of U.S. goods. Their plan is to phase this in, starting the 1st of April and fully implemented by the 13th of April. Now the EU is, at least publicly, emphasizing their willingness to negotiate. They've even hinted at potentially using China as a sort of scapegoat in these negotiations. But let's be clear. This is a dangerous game. We have historical precedent here, and it's not pretty. Remember the Smoot-Hawley Tariff Act of 1930? Many economic historians directly link that act to exacerbating the Great Depression. We're talking about a situation where by 1932, global trade had plummeted by 35%, and a devastating 15 million Americans were unemployed. So, while the current situation might seem like a series of tit-for-tat measures, the potential consequences are far-reaching, and frankly should make all of us pay very close attention. The lesson from the Great Depression is not just academic. The trade war, adding tariffs, is something serious. We need to put them into consideration. This brings us to a critical question. What's the actual impact of these tariffs? It's not just about headlines, it's about the ripple effects throughout the economy. And what we're seeing is a wave of uncertainty. Businesses, from small manufacturers to multinational corporations, are desperately seeking clarity on Trump's trade policy. They're facing a constantly shifting landscape, and that makes it almost impossible to plan. Imagine that. You are trying to decide on a major investment, a new factory perhaps, but you have absolutely no idea what the cost of your imported materials will be next month, let alone next year. Investment spending may have stalled completely in the first quarter simply because of these unpredictable import prices. We heard directly from Goldman Sachs CEO, David Solomon, who is publicly calling for clearer policy guidance. He's not alone. Business leaders across the country are echoing this sentiment. It's basic economics. Uncertainty breeds caution. But Trump, in his characteristic style, is doubling down. He's not only defending the current tariffs, but actively suggesting they could increase further. He also made a point of stating that he doesn't see a recession on the horizon now. That's a bold claim, and it directly contradicts many economic forecasts. And here is where the plot thickens. We have Bank of America analysts explicitly warning that these tariffs could very well push inflation higher, directly counteracting the positive CPI data we just discussed. This, in turn, seriously complicates the Federal Reserve's policy decisions. It puts them in a very, very tough spot. It is clear. We cannot ignore the impact brought by the tariffs, and we need to carefully evaluate it. And that's where the market finds itself right now, in a chicken game phase. It's a high-stakes standoff, essentially testing the resolve of both Trump and the Federal Reserve. Who will blink first? Will Trump back down on tariffs? Or will the Fed preemptively cut rates? It's a period of intense uncertainty, and the market hates uncertainty. Now, most economists, and I tend to agree, don't see an imminent recession. We're not talking about an immediate collapse, but, and this is a crucial but, the warning signs are definitely accumulating. We're seeing a slow buildup of risk factors, like a pressure cooker slowly reaching its limit. We are, in fact, being more cautious, because several major Wall Street firms, including Sid Timbrels, have recently downgraded U.S. stocks. That's a significant shift in sentiment. And J.P. Morgan, they've actually increased their estimated risk of a U.S. recession this year from 30 to 40%. That's not a majority prediction, but it's a substantial jump, and it reflects a growing unease. Consider a situation where recession happened historically. During recessions, the S&P 500 typically falls by around 24% from its peak, and looking back at the 12 recessions since World War II, the average drop at the end of the bear market was 13%. These are the kinds of numbers we need to keep in mind when assessing the potential downside. Remember, the 2008 U.S. subprime mortgage crisis. It almost dragged everyone down. These trade conflicts aren't just a domestic issue. They have global implications, and that's inherently negative for global stock markets. It's an interconnected world, and a major disruption in one area inevitably spills over into others. So what does this all mean for the Federal Reserve? Well, it puts them in a very tricky position, a real dilemma. Their primary goal, their mandate, remains inflation control. That's always at the forefront. Now, if we saw clear recession signals, undeniable evidence of a significant economic downturn, they'd act decisively. We'd see rapid rate cuts. No question, but that's not what we're seeing. Instead, we have this uncomfortable mix of slow growth and persistent, above-datum inflation. That combination might actually delay any rate cuts. The Fed is acutely aware of the signals they send. Cutting rates in this environment could be misinterpreted as a sign of panic or worse, that they're giving up on the inflation fight. It sends the wrong message. And as we talked about, while current inflation readings are showing some improvement, they're still stubbornly high. And those tariffs they're looming, a significant future risk to price stability. They could easily reignite inflationary pressures. To add to the complexity, the broader economic data, while not stellar, hasn't weakened substantially enough to warrant a dramatic policy shift, at least not yet. So the Fed is in a bind, walking a tightrope, a delicate balancing act between supporting growth and keeping inflation in check. We will need to see how things go. With that in mind, let's examine what all this means for next week's highly anticipated Fed meeting. The recent CPI data, showing that inflation is, at least for now, a bit cooler. This gives the Fed some breathing room. It allows them to be a little more relaxed, a little less hawkish in their approach. I fully expect Chairman Powell to maintain a generally optimistic tone on the inflation front. He'll likely acknowledge the progress while reiterating the need for continued vigilance. But I am not sure. The key things we, all investors, need to be watching for are, first, the dot plot, and second, any announcements regarding balance sheet reduction, also known as quantitative tightening or 2-teat. The dot plot, for those unfamiliar, is essentially a visual representation of where each Fed official sees interest rates going in the future. This time around, the dot plot will be particularly insightful because it will provide crucial guidance on the overall rate cut path, and, importantly, it should reflect the Fed's collective views on the potential inflationary impact of these tariffs. That is the guidance we all need. In my opinion, we could also see an announcement about their plans to either slow down or completely stop quantitative. Remember, they've been steadily reducing their balance sheet, and many analysts, myself included, anticipate they might announce a timeline for ending that process potentially as early as June. This will be critical to watch. It is an important signal. Let's shift gears now from the macroeconomic picture to some specific companies that are making waves, and there are two names I think many of investors are very familiar with. It will be Nvidia and Tesla. They really stood out, driving a significant portion of the market's gains. Tesla, in particular, got a noticeable boost from a couple of factors. You had Trump's public endorsement, which, love it or hate it, always moves the needle. And here is a strong possibility of a short squeeze at play, forcing those betting against the stock to cover their positions, further driving up the price. Now, turning to Nvidia, they're gearing up for their annual GTC conference, running from the 17th of March to 21st. This is a big deal in the tech world. The conference is focusing heavily on artificial intelligence, advanced graphics, and even robotics. It's a showcase of their cutting-edge technology. Ahead of the conference, Wells Fargo reiterated their overweight rating on Nvidia with a price target of $185. Now history tells us something interesting about Nvidia and GTC. The stock has a consistent track record of outperforming both during and in the 2 weeks after the conference. It's a pattern worth noting, but there is always some challenges. Here is a potential cloud on the horizon: rising regulatory pressure. Specifically, we're talking about the possibility of the US government implementing stricter rules around AI diffusion rules, potentially restricting the export of certain technologies and hardware. This is something we need to keep a close eye on, as it could directly impact Nvidia's global reach, and that's where Nvidia and Tesla come in. Building on company-specific news, let's take a look at some other major players in the tech sector, starting with Intel. They just appointed a new CEO, and the market's initial reaction: a significant jump in the stock price during after-hours trading. Investors are clearly hoping for a turnaround. This leads us to an interesting paradox, because there are also reports, and I stress reports, suggesting that TSMC, Nvidia, and even AMD are in discussions to potentially invest in Intel's operations. Now, that would be a major shakeup, a potential collaboration among some of the biggest names in the semiconductor industry. We'll have to see how that plays out. In my opinion, it tells a very clear message that investors have very high expectations for Intel. So what does this all mean for investors? Another thing we need to pay attention to is Adobe. Adobe released their Q1 earnings, and it was a mixed bag. They beat expectations on earnings per share, always good news, but their full-year outlook, the guidance they provided for the rest of the year, came in slightly below what Wall Street was anticipating. The market's reaction? A 4% drop in the stock price after hours? That tells you how sensitive investors are right now to any hint of weakness. Even from a company as established as Adobe overall, we can see some mixed signals for the big companies in the market. Let's turn our attention to the oil market, because this is another piece of the economic puzzle that's flashing warning signs. And honestly, the overall sentiment is pretty bleak, increasingly pessimistic. We're seeing a confluence of factors that are all pushing prices down. It is not random, it is because of several factors. First, there is the supply side. We're facing a genuine supply glut. OPEC+, despite previous agreements to cut production, has actually increased output. Russia's exports are on the rise, and US production, it remains stubbornly high, near record levels. So, more oil is flooding the market. Now move to the demand side. At the same time, demand is under pressure. And this goes right back to the tariffs we've been discussing. Those tariffs are acting like a drag on global economic growth, and slower growth translates directly into reduced demand for oil. It's a simple equation. You have got a classic economic problem, a prisoner's dilemma playing out on a global scale. No single producer wants to be the first to cut production. They're all afraid of losing market share. Why? Because if one country cuts, others will happily step in and fill the void, taking the profit. It is a competition. And let's be frank, here is a deep-seated lack of trust among OPEC+ members. You have countries like Kenya consistently exceeding their agreed-upon quotas, throwing the whole system into disarray. It is all about competition. So what's the bottom line? Most analysts are now expecting oil prices to potentially fall below $60 a barrel in the short term, and some are even predicting a drop to $50. This is significant, not just for oil companies but for the broader economic outlook, and especially inflation. Let's shift our focus to the technical side of things, and specifically, what's happening with the Nasdaq 100. I want to show you this because here is a significant risk to the downside that we need to be aware of. It's a specific, quantifiable risk. We've been tracking this, and the situation is this. If the Nasdaq 100's closing price on the 21st of March, that's the key date, falls below 19,500, a specific set of technical conditions would be triggered. I have to say, that could open the door to a much larger decline. So what are the market expectations? Right now, the options market is essentially betting that the decline, if it happens, could bottom out around 18,800. On the flip side, they're pricing in a potential rebound to around 20,300. That's a pretty wide range, and it reflects the level of uncertainty and volatility we're dealing with. This shows we are still in a very dangerous situation, and we need to be careful about the risk. Building on the technical aspect, I also want to share another thing. It's about a significant shift in outlook from one of the biggest names on Wall Street, Goldman Sachs. They've just lowered their year-end target for the S&P 500 in 2025. This isn't a minor tweak. They've revised it down from 6,500 to 6,200. That represents a 4.6% decrease, in the world of Institutional investing, a move like that speaks volumes. It is a big adjustment. It's a reflection of the broader concerns we've been discussing, a more cautious, a more conservative stance, and a more realistic, grounded view of the market. So, we've covered a lot of ground today. From the escalating trade tensions and their potential economic fallout, to the Fed's precarious balancing act, and the mixed signals coming from major tech companies. It's a complex, rapidly evolving situation, and staying informed is absolutely crucial. I hope this gives you a clear picture, and that's where Collin Investing comes in. We're here to help you navigate these turbulent waters, to provide the insights and analysis you need to make informed decisions. So if you found this video helpful, please give it a like. It helps the channel tremendously, and even more importantly, subscribe to the channel for more in-depth updates and analysis. We're constantly monitoring the markets, and we'll keep you informed. Finally, I'd love to hear from you. Share your thoughts, your questions, your concerns in the comments below. What are you most worried about? What are you most optimistic about? Let's get a conversation going. Your engagement helps us shape future content and address the topics that matter most to you.